the fair value gap, probably one of the most popular smart money concepts out there. But here's something most traders don't know. Not all fair value gaps work. Take a look at this one. Price just pushes right through it. No reaction at all. But look at this other setup. Price taps the fair value gap beautifully and then takes off in the exact direction we expected. So, why does one fail and the other deliver a perfect entry? Let us first go over what a fair value gap is. An FVG, or fair value gap, is a three-candle pattern. It forms when the middle candle moves so quickly in one direction that it leaves a gap between the wicks of the first and third candle. This creates an imbalance, a price area where trades were skipped over too quickly. There are two types: bullish fair value gaps that appear in an uptrend, bearish fair value gaps that appear in a downtrend. Price often comes back to fill that gap because the market wants to return to areas where orders weren't properly matched. But here's the catch. Not every imbalance leads to a winning trade, and if you trade fair value gaps blindly, you would just lose a ton of money. That's because a fair value gap is only a confluence, not a full setup. It needs proper context to become valid. Before trusting a fair value gap, ask yourself, has price swept liquidity? A liquidity sweep happens when price takes out obvious highs or lows, because that's where lots of stop losses are stacked. Institutions use that liquidity to fill their massive order sizes. When price grabs that liquidity, it gives institutions and smart money the fuel to enter positions. And more often than not, valid fair value gaps form right after a liquidity sweep, because that's when large orders are flowing in. The second thing we want to see is a break of structure. A break of structure tells us that momentum has shifted. If price takes out a recent low in an uptrend or a recent high in a downtrend, it's a clue that smart money may be flipping bias. And that's when the fair value gap becomes powerful. Here's how I used this in a recent trade. First, price pushed below a key low, taking out sell-side liquidity. Right after, we get a break of structure to the upside. Then price forms a bullish fair value gap. Once we tap the fair value gap, we switch to the 1-minute chart and wait for a second break of structure to confirm our entry. We put our stop loss just below the sweep and our take profit at previous highs. And just like that, price explodes in our direction. Here's what you need to remember. Fair value gaps are great, but they don't work alone. Look for liquidity sweeps first, then wait for a break of structure. Only trade the fair value gap after that context is in place. Without confluence, and fair value gap is just a gap on your chart. If this helped you, leave a like and subscribe for more breakdowns like this. I'll see you in the next one.